gentlemen, welcome to the show. Without further ado, let's get into it, guys. I've been trying to put together this live stream for like a month or two now and constantly procrastinating actually getting started. So today, we're winging it, we're getting right into the show, and we'll see how it goes. Like and subscribe if you want more content like this, and of course, I'll be your expert in the mortgage note industry for 2020 and beyond. So let's get into it here. So I'm working with OBS. So I want to tell you a little bit about the stream setup here so you understand what's going on. This is live, no editing. We're doing it all on the fly here. I'm going to test, see how the frame rate looks, see how the scene transitions look. And actually, I'm not even talking in the microphone here, so I'm going to put that in the right place. We've got 4 angles. Let's take a look at all the angles we've got. We've got my presentation in the upper, depending on which way you're looking, the presentation's in the far right corner. Then we've got the bird watching cam in the lower left. That's just a fun Logitech webcam. We'll see if we can capture something along the course of this stream. And then I've got a webcam on my Mac. You can see me here. And then of course, the main shot is the DSLR. So let's just start with the presentation, shall we? Oh wait, that's the bird watching cam. All right, so our main shot is right here. This is our presentation. This is June 2020, the mortgage notes industry. I'm going to tell you all about it, what I think you can do to benefit yourself going into this industry, or if you're already a participant, either as a vendor or an investor or a servicer, anything to do with this industry. We're going to try to show you how you fit in and how you can expand your business. So let's do it. My show is called Be the Bank. This is also our Instagram handle. You can find us at instagram.com/be.the.bank. I think that's the URL. If not, just look us up. This is episode number 1, June 10th. We're going to be talking about the overview of the industry. We're going to show you how this tech enables us to do this from wherever you are. It's a laptop and a cell phone business. We're going to do some case studies. We're going to show you some asset opportunities and hopefully some giveaways. We'll see how that works out. So if my keynote responds here, we're going to start with the industry overview. And then obviously there's some of the other things that we're going to cover in the future. Are we going to do interviews maybe on this channel? Let me know in the comments below if you want to hear interviews from investors and other industry participants. That's FIXnotes. You can visit us at FIXnotes.com. We've got a lot of content on the website, including how to invest in mortgage notes, which is a guide, everything you know about investing in mortgage notes for free. So go to FIXnotes.com/learn for that. Okay, so I want to start out with market pricing. It's the end of second quarter 2020, and it looks like the performing note industry is starting to see some discounts. I'm seeing 20 basis points reduction in pricing on senior liens, a 10 basis point reduction in junior liens, with increases on the non-performing side. So just so I can kind of decode this chart for you, we're talking about the secondary mortgage industry where non-performing and cash flowing performing loans are traded between market intermediaries. And these trades are done at a discount to the principal balance. Or in the case of senior liens, a discount to the fair market value. FMV is the fair market value of the home. UPB is the unpaid principal balance of the debt. I'm not talking into the microphone again. I hope you guys can hear me. Okay, so as you can see, performing senior lien is the upper left quadrant of this grid. And we're seeing pricing between 7.5% and 12.6% as the yield. Now, this is a cash-on-cash return. So if you're receiving, for example, $1,000 per month, and you want to sell that loan, or say you're looking at a loan to purchase that cash flows at $1,000 per month, that the low end of that range, 7.5% cash on cash yield, you take $1,000 a month, annualize, that's $12,000, divide that by 0.075, which is 7.5%, and that looks like a $160,000 purchase price in order to earn $1,000 a month, $12,000 a year. So you'd be earning a 7.5% yield on the very, very low end. So we're talking about high quality senior liens. They're paying via an automated clearinghouse, an ACH agreement. They have a substantial amount of equity. They're like the cream of the crop. You're going to be buying those loans at a lower yield because the risk is lower. Whereas on the high end, Senior liens can be traded at 12.6% is the range that I'm seeing as kind of the high end, but they can trade for higher than that. We purchased first liens before. My clients have purchased performing first liens at as high as a 15% cash, excuse me, a 15% cash on cash yield. So that formula on junior liens works the same way, but the junior lien range is a little bit higher. It goes from 12.4 up to 22% yields. Those are cash on cash returns, and you're seeing higher yields in junior liens because they're slightly more risky. On the non-performing side, we're seeing increased pricing, and this is perhaps something to do with the current pandemic environment, but I've heard from several market intermediaries that pricing is actually increasing on the non-performing side. So these are loans that are in default, no longer paying. In first position, we trade this type of debt based on the fair market value. In second position, we trade this debt based on the unpaid principal balance. So for fair market value in firsts, we're seeing trades between 22 and 84% of the value of the home. Obviously, that's capped by the unpaid principal balance. You're never going to pay a premium to the UPB. And then finally, in junior liens, we're seeing trades from 5.5% all the way up to 61.5% or so. And that's an increase from last quarter by almost a full percentage point. So that's an interesting metric to follow, but I would not let that dissuade you from contemplating deals, even if the pricing seems high, because in a bubble, it might. And I'm not talking about an asset bubble. I'm talking about in this context, looking at this chart, some of these numbers seem high, but when you think about it, 61.5% at the high end of junior lien trades, that's 40% or so discount to the principal balance. So you're actually buying a $100,000 debt for about $61,500 or less. So there's a lot of upside there. Even if pricing has increased, there's a lot of money to be made as a non-performing loan buyer who's able to craft borrower-centric resolutions. And that's really the crux of this business. We're helping borrowers, and we're helping them come to terms on non-performing loans that they either need to modify or negotiate like a discounted settlement or some other form of resolution. May that be a deed in lieu of foreclosure or taking back the property through other means because the borrower no longer has an interest in retaining it, or working with them to retain the property by coming up with a payment plan of sorts. So we'll learn more about that when we get into the case studies. Let's see what's next. We're a little rusty here. This is our first show ever. Oops, and I have two keyboards because the presentation's running on a separate computer, so I need to make sure I remember that. All right, let's talk about the tech overview. I think this is something that most of you guys are excited to learn a little bit more about. Hardware-wise, all you need in this business is a capable PC or Mac, a decent smartphone, and you can't see it because of my dumb head here, but fast Wi-Fi and cellular. You definitely need a good internet connection because we run this business primarily from our computer. And using a suite of software and web services, we're able to do a lot of really awesome things. So the brains behind my business and a lot of my clients' businesses is Podio. Podio is a CRM. It's free up to like 3 or 5 users, and then you can pay some money to add some additional features, creating automation and other sort of efficiencies. But at the end of the day, it's a database. It holds information. So that's where I track my clients' portfolios of assets. I log activity on those assets. I track payments that we receive and expenses that are incurred. All of our due diligence and research is tracked there, and we'll touch on that as we explore some of the other vendors that we work with. Pacers, public access to court electronic records. They're the government's database online into bankruptcy records. Super important in this business to understand that side of the legal atmosphere. Globaflow is connected to Podio, and that's what I refer to for the automations. That allows us to connect our various apps, is what the technical name in Podio is called. It's an app, which it's really just a spreadsheet of data. And every app, for example, my inventory app communicates with my credit reports app, so that the inventory that we hold is updated when a new trade line, for example, a senior mortgage trade line on the credit report can be analyzed when we're buying a junior position debt. Right signature, we've tied that into Podio as well so that we're able to send contracts that are able to be executed from your email. Zapier is sort of a fill-in-the-blank it's an easier way to connect web services. And that's how I started using Zapier more, because I can figure that out without as much technical know-how. But I've graduated beyond Zapier to more JavaScript with the help of developers in Podio and Globoflow. Zillow, of course, is an excellent resource for property information. I really like using Zillow to link right back to the county record. If you click see additional data sources in the main Zillow screen, and then there'll be a pop-up, and then you scroll to the bottom right and click direct to county, or it says county data, show county data. You can click that and you can see right to the source, the tax records, the name of the homeowner, all sorts of things directly from the county record if that county is online. There's DataTree when the county is not online. DataTree is a first American product that allows you to research property records and also order deeds and assignments of mortgage and other public records you can order through this platform. It makes it very easy to search across the country. Then we've got Pro Title USA, which is similar to DataTree in that you can do some title research there, but Pro Title is an official vendor. They will use abstractors who are licensed to do that work. And then you're able to order an ownership and encumbrance report, which is also called a title report, for about $90 to $100. That's a lot more accurate than what you'll research on your own. Then over back to the left, we've got Google Sheets, of course. There's a lot of great things you can do with Sheets. Excel, though, I always fall back on Excel for all sorts of Excel-specific formulas and macros and things that you can only do on Excel, but Google Sheets is also a very excellent option. And then finally, in the bottom right-hand corner, we have TransUnion TLO. TransUnion, as you may know, is a credit bureau, and they're able to order batch reports for us. I actually just ordered 50 credit reports the other day for some research. And then TLO was just acquired by TransUnion. And TLO is a skip tracing resource that allows you to learn a whole lot about your homeowners when you're doing your research or when you're attempting to come to some resolution with a borrower. You can get a lot of information there. And we have a permissible use as debt buyers to conduct this research because it's of economic interest when completing a transaction. So that's important because using information like credit reports and skip tracing data and some public information is one thing. You can go to the county record and you can see that as anybody. But as a debt buyer, you need to make sure that you have permissible use from the seller who you're buying assets from before you conduct due diligence, or if you already own the asset, you have permissible use to order credit and do things to protect your interest. So this page here, we'll come back to this in future episodes, and we'll absolutely drill in and provide some specific tutorials and other information on the different vendors that we implement here. So you're welcome to type some questions either after the fact or while we're on the live show to let me know what you think and how I can make things a little bit clearer for you here. All right, let's see what's next. Oops, I'm doing it again. I'm pressing the wrong keyboard. Okay. So next we've got asset opportunities. So we've got some loans for sale. And this is something that our business does. Oh, and look, my dumb face is in the way again. There we go. So we've got some first liens available for sale in Q2. We've got 56 assets with a total unpaid principal balance of about $2 million. The fair market value is $2.1 million. So we've got a little bit of equity. And right off the bat, I can tell that this was not checked because 1.87 million of equity. Oh, never mind. I know exactly what the case is. So I don't show it here other than this field for taxes. But when you're buying first position debt, the main thing you have to look for is the status of the taxes. Because if the property owner is not paying taxes, they can potentially be foreclosed and lose interest in the property, which would strip your lien from being secured by that property in the event of a foreclosure of the taxes. So the equity figure here of 1.877 is the 2.112 fair market value less the delinquent taxes. And that would have made a lot more sense if I included the tax balance here so you could track that back. But essentially when you're in first position, which all these loans are in first liens, your equity is only a function of your unpaid taxes as well as your unpaid homeowners association bills, if that's also the case. But not all properties are in HOAs, so that's not a big deal in most cases. In this case, though, there are 6% condos, and we would expect to see a lot more HOAs in the condos. So that's an important research point when you conduct your due diligence on a portfolio like this, to make sure there's not a homeowners association, and if there is, to make sure there's not a past due charge for the homeowner from the HOA. Because some states are what are called super lien states. A super lien state, the homeowners association actually can have a priority lien over a first position mortgage if they turn their past due invoice, whatever they're owed as the HOA, and they turn that into a lien against the property. You can actually be pushed from first position to second position in a super lien state. And we can get into that more in future episodes. There's a lot of really nitty-gritty information that's important to understand in this business. And I share a lot, if not all of that I have on FIXnotes.com/learn. You'll be able to review every single state's foreclosure laws and other details about their processes across the country. So that's important to understand, and I encourage you to go check out How to Invest in Mortgage Notes. It's a free online course on FIXnotes.com. So this portfolio is a blend, as you can see, of vacant land and single-family homes securing the debt that is being sold. It's mostly non-bankruptcy. 83% is not in bankruptcy, and there's a couple discharged and dismissed bankruptcies, which, as we discussed, you use PACER, Public Access to Court Electronic Records, pacer.gov, to research bankruptcy. So you can look through the docket and really understand your position as a lien holder or a future lien holder if you're researching to purchase a loan, what the bankruptcy has an effect on your interest in that property. So this portfolio is, I did it again, wrong keyboard. Let me just put this keyboard right here. So this portfolio, 56 first position liens, my client, U.S. Mortgage Resolution, is marketing this for about $500,000. It's an all or nothing number. So by acquiring the portfolio at $500,000, you're in at a quarter, 25% of the unpaid principal balance, and around 26.6% of the equity. And the equity is the fair market value net of the taxes, as we discussed earlier. Of course, cherry picking is acceptable. You're welcome to make one-off offers on this portfolio. If you just identify one or two loans, you don't want to buy $500,000, 56 loans, you could just buy 5 loans or one loan even. Although I would not recommend purchasing one mortgage note. It's really important to diversify in this business and spread your risk across a couple different assets. And you can find out more of that by going to FIXnotes.com/buy, where you'll sign a non-disclosure agreement so you can get access to this complete data tape. As we discussed earlier about permissible use and confidential, personally identifiable information, it's very important that note sellers, my client is a note seller, have their buyers execute non-disclosure agreements, because these are confidential. It's confidential information. Borrower social security numbers, for example, need to be used to pull credit. And that type of thing is very important to keep safe. So non-disclosure agreements are very important in this business. And as you learn more and see more portfolios available, do not be intimidated by the fact that you need to sign a lot of NDAs. Make sure you read them, of course, but understand that that's an important part of this business to protect the borrower's personally identifiable information. Let's go on to the next slide and see what we got. Okay, so case studies is next. This is an exciting part of the call. We'll try to do new case studies right now this is supposed to be an every Wednesday show. We'll see if that comes to fruition here. But please comment, like, subscribe, be part of the group to encourage me to keep this up if you find like you got some value out of it. So our first case study is a vacant land lot. It's a first position lien secured by vacant land where my client was able to have a short sale completed. A short sale is essentially where the borrower owes more than the value of the property. The UPB, the unpaid principal balance, is more than the FMV, the fair market value. And on this case, you can see it's not super underwater. It's about $300. No, my bad. $3,000 underwater or so. So that's not the worst I've seen. I've seen other cases where the UPB is like $300,000 and the borrower owes, they owe $300,000 and the property is like $100,000. So that's $200,000 underwater. That's a different situation than this. However, in this situation, it's still a short sale. The borrower wants to sell the vacant lot, and in order to do so, they need an agreement with the lien holder, the bank. Be the bank is what this is about. Buying notes, you become the bank. and they needed an agreement from that lien holder, the note owner, the bank, the lender. There's a lot of ways to say it. They need an agreement with them to settle the debt for less than is owed. So we normally ask 3 questions when we start talking to a borrower. What happened? Where are you now? And what do you want to do? So they were diagnosed, the primary borrower was diagnosed with cancer. The co-borrower was laid off. Hold on, guys. We got to switch to the bird scene because there's a bird out there. You can see his tail, right? I don't know what kind of bird it is. Oh, there he is. I need a little bit more lighting so you can really get a good idea of what kind of bird this one is. I think it's probably like a starling or something. Another thing I gotta learn for this stream is my bird species so that I can be more of an expert here when we spot one. All right, back to the presentation. So the co-borrower was laid off work, the borrower was diagnosed with cancer, and they're on disability, they're receiving the cancer treatments. The co-borrower started a landscaping company, and a previous lender, so the bank that owned this debt before my client purchased it, offered to settle for $2,800. So that was a killer deal. They were almost able to settle $26,000 of debt for $2,800. And we knew that because we saw in the borrower's collateral file, the collateral package. So there's 2 ways we use the word collateral. One is the documentation, and that's what I'm talking about now, the paperwork, the contracts. And the other is the actual physical property, the collateral that secures the debt. So in this case, I'm talking about the physical, the documents, the note, the mortgage, the assignments, and the allonges. So we saw in that collateral package that there was a $2,800 discounted settlement on the table that the borrower was not able to take advantage of. So when we had this conversation, they said, well, we want to pay off the loan. Just like the previous lender offered us a discount, we want to pay it off as well. So we offered a $9,900 discounted payoff. So that was a 30-day timeline. If they could pay it off in 30 days, they could settle $26,000 for $9,900. And then we had an additional incentive to pay that off sooner because every month after 30 days, there'd be a $1,000 a month increase to the potential payoff. And unfortunately, before they could take advantage of this discounted payoff, the Homeowners Association, the HOA, began a foreclosure for that $6,300 Homeowners Association balance. The good news was that there was no taxes, so the equity figure in this case is only a function of the fair market value and the Homeowners Association. So we advised the borrower to sell the property, and we would accept a discount. So we started off the listing at $29,000, which would have covered both without a short sale. But after 60 days, the best offer we got was $25,000. We used the short sale as a negotiation leverage point with the Homeowners Association. We're taking a discount, so you should take a discount as well. The Homeowners Association agreed to that. They settled for about $2,000 less. And after the realtor fees, and let me move my mug. Oops, wrong window. After the realtor fees and everything, and we gave $1,500 to the borrower to help them with the moving expenses. Actually, this was a land lot, but $1,500 was an incentive for the borrower to cooperate with us, and we received a check for about $15,000. So that deal, as a non-performing loan, is worth about $7,755. Let's just do a little math here. 7,755 divided by 26,000. So as a non-performing loan, that was worth about 30 cents on the dollar, 30% of the balance. So we would have sold that loan to an investor for $7,700. And if they were able to complete the same deal that we did, selling it for $15,000, and that's selling the property, so the lien no longer exists. We get a payoff, we release the lien, we agree to waive the right to pursue any deficiency balance, and a deficiency balance is the amount that they would still owe, because this is a discounted payoff. The deficiency balance could be pursued, not as a secured lien, but potentially as a judgment against the borrower, because they signed a contract and that debt is still valid. Even if the property is gone, they still need to pay back the debt. But because they were cooperative with us, we waived the right for any deficiency balance. So by settling the $26,000 debt for $15,000, that borrower is now free and clear. They don't own this property anymore. Someone else purchased it from the realtor, and the realtor paid us at the settlement. So this is a great deal to double your money. And if you can do it in about 90 days, your rate of return is excellent on a deal like this. Let's move on to one more case study. Oops, wrong keyboard again. Oh my gosh, I gotta get used to this. Okay, so next, this one's actually secured by a property. And this case study is a little bit different. We're not talking about a resolution. We're talking about a loan that's under contract. And I believe this loan settled. We closed this loan with a non-performing loan buyer a week or so ago. So this is a Ohio non-performing first lien. The value of the property is about $38,500. They owe $6,500 in taxes, which leaves $31,966 of equity, and they owe $65,000. So they are underwater on this account. This loan we have under contract, and I believe, and we'll touch base on this next week to confirm that we were able to sell it, but it was under contract for $15,000, which is 46.9% of the fair market value net of taxes, in other words, the equity. And it's 22.9% of the unpaid principal balance. So technically they've got almost 80% upside if they got a full payoff, but that's very unlikely because the value of the property is less than the balance due. So they've got about a 63% upside on the fair market value. And that's not just the fair market value, but the fair market value net of the taxes, the equity. It's not owner occupied. This borrower no longer lives there. They have a 502 FICO score, so not super great on their credit. They're not paying their taxes, and they're trying to sell the property. The property is currently for sale by owner for $38,500, which gives a investor a little more confidence as to what's expected here. The borrower doesn't want the property. That answers question number 2. What do you want to do? Remember, we asked 3 questions when we talked to a borrower. What happened? What do you want to do? Wait, what happened? Where are you now? And what do you want to do? So that question is answered when you see that the property is listed on the MLS. They do not want the property anymore. The strategy here would be to offer about a 50% UPB, a 50% of the balance payoff, if and when the borrower is able to find a buyer, and choose to forgive the deficiency balance. That's up to the investor, but I would definitely recommend it in a situation like this, especially when you're buying it for $15,000. You're able to offer a lot more to a borrower when your cost basis is lower. So just to understand some of the other expenses that this non-performing loan buyer is going to incur, $25 per month in servicing fees, $25 or so to record their assignment of mortgage, which puts them in the county record so everybody knows that they own the debt. And then there's other real estate expenses if the property sells. You're going to pay realtors, you're going to pay closing costs. And then finally, you may pay for a skip trace and legal fees. If you're not able to work out a deal with the borrower, you may have to move forward with a foreclosure or at least send a demand letter to show the borrower that this is a serious situation that needs to be resolved. And right now, because the borrower has the property listed, it's I think it's kind of a waiting game because you can see that the borrower is doing something. The property is on the market. By forcing it here, by sending a demand letter and initiating foreclosure, you may actually make the property sale a little bit less attractive to a buyer because there's all of these moving parts. Short sales in general can be a little bit more difficult because, and I'm saying difficult on the real estate side because realtors they understand that short sales have more hoops to jump through, and buyers, when they see a listing as a short sale, can sometimes be a little bit skeptical about the situation. So by furthering that stress, by initiating a foreclosure, you might actually be undermining your ability, well, the borrower and the realtor's ability to sell that property for top dollar. So in this case, I would want to get in touch with the borrower and have a dialogue to understand that we're both on the same page, and then provide any assistance that they need to help sell the property or help their realtor sell the property. So that's 2 case studies for you to get started on our first episode. 1 case study that's a resolution and 1 case study that's a sale. All right, what else have we got? Next, we're getting into giveaways. So this is a little bit of an experiment. I don't know how this is going to work out, but I've got an idea here that all the money that YouTube for us could potentially generate, it's going back to YouTube. I'm not starting this channel for any profit motive whatsoever. In fact, if you go to FIXnotes.com/learn, or you can just go to the homepage and you'll find it, we offer an entire free online education for Mortgage Note prospective investors as well as more seasoned investors. There's a whole bunch of resources on my website that we give away for free. So this YouTube channel, it's the same philosophy. We want to give it all away for free, but you can totally support it by liking and subscribing, and then leave a comment. So the idea for this giveaway is that if you leave a comment, we'll give you an Amazon gift card. Not everyone gets an Amazon gift code, but if you subscribe, like, and comment, we're giving away 3 Amazon gift cards for the first comment, the top voted comment when we produce our next show next week. Hopefully we do that. And then the top rated comment by, actually no, this one, and once again, gotta move the keyboard, gotta move my face. Oh, frick. Sorry guys. Okay, here we go. A random comment, here, I'm down here now. A random comment will be awarded a code, a top rated comment will be awarded a code, and first comment. So please, you gotta subscribe first, then like the video, and then comment, and we can hopefully, this keyboard, we can hopefully hook you guys up with some Amazon gift codes. But since we haven't earned anything from this channel yet, our gift code is probably gonna be like $1 for this stream. But if you guys can support the channel and we can grow, then of course we'll have deeper pockets in order to incentivize you guys going forward to be a part of the group here. So please consider supporting us with a like, a subscription, which is totally free, and also a comment. All right, let's see if we got another slide here. Oh yeah, double prizes for creators. Guys, I like, it was, here, let me move this down. For me to do this stream required so much second guessing, so many false starts. It's hard to produce content, and to be a creator online is very hard. So I really want to encourage that. If the prize for the 3 prizes, top comment, random comment, and first comment, if those prizes are the awarded buyer, or the award, what am I saying? The awarded viewer is a creator, and I go to your YouTube page and you're consistently putting out content, then that price is going to be doubled from $1 to $2 because, or maybe it'll be $5 to $10. Who knows? We'll see what kind of response we get to this first live stream, and we'll take it from there. But I want to encourage you guys to be creators, to add value, to get out there and get outside of your comfort zone. So I wanted to create some incentive for you to be a creator and to participate in this channel. All right, what else have we got for you guys? I think that's it. Let's run through the show again. We do industry overviews, tech overviews. We talk about vendors. We didn't do that today. Asset opportunities, case studies, and giveaways. Maybe we'll even do interviews. So that's the Be the Bank show every Wednesday from FIXnotes. Thank you so much for joining us, guys. Let's just go around the horn one more time with our other shots. Oh, look, there's the presentation software. We use Keynote here. We love Keynote. All right, so as you guys can see, this is the show. We've got 4 angles. We got our presentation in the upper right. We got me down here in the lower right. We've got over here the DSLR in the upper left, and then of course the bird cam. We saw 1 bird today. Maybe we'll see some others. Sometimes we see foxes and deer. So this is really fun to have that extra camera angle. And let's see what else we got here. Yeah, bird cam. All right, well, that's it, guys. This was a lot of fun. I definitely need to do a lot of work to polish this up here. Let me go over to our final scene here. Let's see if it works. All right. So I'm gonna have to watch this video back and see how our audio levels were, how our frame rate looked, how these different angles work together, and if there's any stuttering with the video. There's a lot of things that I think we can clean up going forward. But if you got the gist of this show and you want to support it, you want to get into this industry, you want to be the bank, level up your real estate game from somebody like a landlord who buys rental properties all the way up to the bank, collecting mortgage payments from landlords every day without the liability of property ownership and with all the benefits of a work from home, computer, cell phone business. And stay tuned, like and subscribe, leave us a comment with any questions, and maybe you'll even win a gift card. Thank you so much for joining us, people. And until next time, I'm Robert Hytha, your host of Be the Bank. Check us out on Instagram, Facebook, elsewhere, and tune in next Wednesday for another episode. All right, guys, thank you. Peace.